Let's talk about inflation and its impact on your buying power. I'm Justin Hitt with Sustainable Wealth Secrets. It is no secret today that in 2021, we are facing rapidly growing inflation. Inflation is where your currency, the money you use, has less buying power in the marketplace, either due to monetary policy or due to changes in the marketplace that causes prices to go up quickly. Now, this inflation is not just something that's happening in the last couple of months or years or because of the COVID or because of supply chain issues. It is part of the monetary system, and it happens on and off throughout the years. Because here's one thing the key takeaway of what I want to share with you today is that inflation isn't a new concept. In fact, when you go look into inflation, you'll find in the 1950s, the 1970s, in the United States, there was cases of runaway inflation. In Germany, in France, and other countries, cases of runaway inflation. It is I don't want to say a natural part of a money system, but when your money is not tied to physical assets, so the money can be printed by the government, there always tends to be some kind of inflation. And it could be a deflation. It just depends on how it's going. But some condition where the cost of goods goes up faster than salaries, faster than you might imagine. And in many cases, making a $100,000 a year salary only have the buying power of someone making $50,000 a year. Now, economists smarter than me call inflation the tax on the poor. If you are in a high wealth situation, very often you can shift your investments into fields that can easily change their prices and that will adapt, because they're necessary goods, will adapt to the inflationary situation. So I'm not going to be recommending gold and silver or recommending, buying toilet paper or even buying physical goods. I want to just cover the concept that no matter what happens today with inflation, that there are enough historical examples for you to follow a path that helps you profit from inflation. I'm currently working on a report called Profit from Inflation, and I'm documenting these different areas. Let me cover a few. First off, when things become more expensive, you can't be in a situation where you're already spending all the money you have. If you're not currently investing, if you're not currently buying down debt, if you're not currently managing your household in such a way that you have emergency fund, that you have emergency food for even a natural disaster, it won't take much for you to get wiped out. All it takes is for prices to go through the roof and there be a disruption in the supply chain, and suddenly building a house goes from $200 a square foot to $350 a square foot. It could be a situation where, normally we're buying goods from foreign countries because there's a lower wage, it lowers the cost, and then all of a sudden you've got to buy food in your local area and you're paying a premium price for that food because the supply chain's been disrupted and the cheaper food cannot come in. There's also the situation where as prices increase, the manufacturers package things in smaller containers. So if you get a quart of ice cream, it's still a quart if you're buying a quart of ice cream, but if you really look at the packaging today, it's not a quart of ice cream. You're just calling it a quart of ice cream because you're used to it, but the actual container is much smaller, even though it's the same price. And this happens in a lot of other different food areas. The key to understand here is that, again, it's happened before. Inflation happens when the government can print money or they're overspending. So that as the U.S. government increases its debt ceiling, there will be inflationary activity. Now, the Federal Reserve is trying to buy back currency and buy back investments and do things to control inflation. But ultimately, inflation will always run its course when the money is disconnected with the physical goods, the value of something. I was looking on eBay for old books on inflation, and I noticed this one book in the corner. The book's called Money, the Greatest Hoax on Earth, written in 1971. Because again, they had, after Nixon took U.S. dollar off of the gold standard, there was a period of inflation because they printed a lot of dollars. But ultimately, in the corner of this book, it says exchange value, 31 grams of silver, 0.999, or 1.9 grams of gold, 0.999, or equivalent paper notes. Now, why am I sharing you that with you this? Well, first off, physical assets tend to have a market value. So if you're going to buy physical assets and incorporate them into a product, if you're going to buy physical assets and use them in construction, that value of that physical asset is more tied to supply and demand than something that is arbitrary, such as a service. Now, in this case here, this book says 31.1 grams of silver or 1.9 grams of gold. So if there's an exchange value, this tells me an equivalency between gold and silver. Okay. And of course, the price of the book. Now, today's dollars, this particular book is $24.73. Now, I didn't calculate the price of gold, but if we can look at the parity between two items, gold and silver, timber and gold, whatever, you can use the gold as a parity to see whether or not we have a price inflation, to see whether or not we have a demand that's causing inflation. So if I look up 1.9 grams of gold, the equivalent, the value of 1.9 grams of gold, which I am now doing on my hand here. Okay, we'll find out whether or not there's equivalency, and that equivalency is you can lock it in throughout time. And by doing that, you're able to determine if something's inflated or not. So if 1 gram of gold is 32 cents today, wow, that's really, oh no, I'm sorry, 1 gram is equal to, let me just finish this up here. The key to understand is if you can find in historical a parity between two items, gold and silver, for example, that's probably the easiest way. And you find a point where the amount of gold and the amount of silver is the same dollar value. You can use that to determine if dollars today are inflated. So you can see if there's a big difference between 1.9 grams of gold versus 31 grams of silver. You can also use it to determine whether or not the goods that you're purchasing are relatively more expensive or less expensive. So if you are in your, let's say you're building a house and you buy a certain amount of lumber, if you pin that lumber against gold and then compare a future price of lumber versus the same amount of gold, you'll be able to see if that lumber price has increased because the physical gold becomes like a monetary measure. It becomes a baseline measure. These baseline measures can be parodied, platinum and silver, or it doesn't really matter because the physical asset has a utility value that drives price. It has a demand that drives price. Ultimately, what you're able to do then is to buy things when they are a lower relative value to the market and then sell them when they have a inflated value in the marketplace. See, inflation means prices are going up. And if you're a consumer and all you're doing is buying, then your prices will go up. However, if you're a producer and you have surplus that you're selling into a marketplace and you can adjust that price according to the marketplace, you can get the equivalent value of the inputs back out at the sale. So if you started manufacturing something and the manufactured unit value was 1.9 grams of gold or the equivalent dollars, you can actually make sure that the current price of the item has been adjusted for inflation and has the equivalent buying power of the unit of the gold measure here. Now, this is not something you're going to be doing every day. It's something that you would do kind of on a quarterly basis, and it works out best if you're making large decisions. When it comes to profiting from inflation, it's understanding when it's important to buy more food or non-perishable staples, things that you're going to have to buy in the future anyway, Like we buy toilet paper like once a year or once every other year or something like that. And I get a huge box of toilet paper and I just use the toilet paper as we need it. And I fixed my cost of toilet paper. That's what this measure is for. So if you're going to buy land and you can compare the historic gold amount of gold it took to buy 1 acre, and now you're comparing today and you find out that it takes less gold to buy an acre, then you have a depressed price or a deflation in the category of land, and you can purchase that land. Now, if you go and find out it takes twice as much gold to buy the land, and you're selling land, then you know to raise your price accordingly, and you can make sure that your price is high enough that you profit. Another way of looking at this is Charlie Munger talked about current value of money and future value of money. If you're going to do it, because I just gave you a historic example, looking back at the purchase price and making sure your cost basis is clean. If you're going to buy something now that you plan to sell in the future, such as a stock or an investment, you want to buy it now and then determine, will it meet a future value greater than your current value? So you inflation adjust your purchase price, and then that's the price it's got to reach to break even. And if you can't project that it'll reach that to break even, then it's not a very good investment. Now, if you project that you're going to meet that price to break even, then you know when you should sell beyond that point. Because ultimately, $100 you had 10 years ago doesn't have the same buying power as $100 today. And $100 today doesn't have the same buying power as $100 10 years from now. And depending on which way inflation's going or deflation's going, you can make adjustments along the way to make sure you're really locking in value. Now, what's the most practical approach at this? Well, understand that, maybe you made $100,000 a year 5 years ago, and now you're making $110,000 a year. It doesn't mean you're making more money. The number's bigger, but if you look at the equivalencies, if you look at the buying power in the marketplace, you are actually earning less 10 years or 5 years after that 100,000, even though the number is 110. Now, I know this can be confusing. A lot of people don't think about money this way. They just kind of see the money they have in their pocket, and if the number's bigger, they're happy. And I don't mean to bring you disappointment, but that's not really how money works. Money works as a storage of value, and if you're storing in cash a certain amount of value, but you can't convert it back out to get at least the same amount you put in, then you've lost money. And so inflation is a situation where you're going to lose money by default because the dollars themselves buy less in the marketplace. Now, again, there are other perspectives. You might be able to buy less in the marketplace, but the quality of what you buy is much higher. Maybe you spend a little bit more money buying local foods, but the nutritional density is much higher. Those are other aspects to consider. We can talk about those another time. I'm Justin Hitt with Sustainable Wealth Secrets. If you have questions about profiting from inflation, about these dollar costs or these cost comparison factors, especially if you're running a business that has inventory, just contact my office. Visit me at www.sustainablewealthsecrets.com. Ask your questions. I'll answer the questions in future podcasts. But we've really been talking about inflation and how to address it and how to discover or identify gaps in the inflationary areas where maybe prices have gone up or gone down, and it gives you some kind of margin. I'm here to help high-income professionals transform their income into wealth that is secure and cannot be taken away, and that grows naturally for the benefit of your family and your community. Thanks for listening.